From the morning reading, Monday marked the 10th time during this bull market that the S&P 500 fell from the recent high to below its 100-day moving average. All 10 times, stocks rebounded over the next 1 to 2 days. 7 of those times it marked the low for months. When the market's rebound was meek, it led to further losses. This is worth paying attention to as a potential change in character and in a less inviting market environment for long positions on a longer time frame. Further, mom and pop investors have drawn their money market balances down to the lowest level since 1998, while large institutional investors are nearly holding their largest amount of cash in 4 years. Prior to the last 2 bear markets, there was a similar divergence between the two, but much larger than we're seeing now. Next, I want to take you to this chart right here from our friends at Shadow Trader. Note the green circles. They highlight the times the McClellan Oscillator marked the bottom for the SPX with a reading very close to or below minus 200. The only false alert during the period on the chart above came just before the bottom in the October of 2014. You see it in the red circle here. The signal is certainly worth traders' attention. Now, the McClellan Oscillator is very close to the minus 200 level once again. Be monitoring the reading closely to optimize a reversal entry on the SPX. So here we are talking about reversal entries and divergences and the like. Where is this going to go? Well, hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:31 a.m. Central Time, and I'm recording this in preparation for the market day of June the 9th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in. And picking up off of what we were talking about here, I want you to take a look at the VIX. You see we're up here near this area of general resistance, and indeed if you drew the Keltner bands, you notice right here that we've had a close, first day close, outside the Keltner band. Now the reason this is important is if you go back, you can count how many times we get a close or even a touch of that upper Keltner band, and then that marks the reversal point for the VIX. Now there's always the big one, and remember that it's like this one. This is last October, and then we had this one here. You can always have the departure, and obviously when you finally get that big breakdown, it's going to be the one that runs through all those expected pullback signals and breaks down much larger. But if you've got one eye on the signs and symptoms of the breakdown, but then both eyes always on what's the most probable outcome. Well, for every time this happened, you had about 6 or 7 of these where it gets to the Keltner band and then reverses. So you put that together with everything else, and you start to get a feel for, what is the most likely outcome. Most likely outcome is that we have just simply come back to near the bottom of the current range, and then we bounce back up towards the top of the range once again. You see the SPX is very much in the range and isn't even yet quite extreme in that range. We certainly have a little bit more room to the downside, and we're still in the range. Now obviously we start breaking through the range, we'll be more concerned. But yet not all panicky, because here in this day, I distinctly remember this day triggered an increased level in the hedge risk level on my system, and yet 2 days later we're at the top of the range. So these are assessments of hedge risk levels, they are not predictions of a downturn. And you've got to separate the two. An assessment of risk is a very important symptom of what we do to manage our portfolio, manage trades, entries, exits, and the like. An assessment of probabilities in terms of where we think the market is going in the next few days is a totally separate thing. And as we've seen, when we've had these prior range bottoms, often we've come back and 2 days later we literally are 80% of the way back to the top of the range. Now, I can't say that that's what's going to happen this time, but that certainly has been the pattern that has happened in the recent past. If we look at the others, DJX for the Dow Jones, obviously very much in the same place as the S&P, the NASDAQ, obviously big down day there yesterday, but you know, this is a range. I mean, I would have preferred that it stayed above this area right here, and certainly that's a breakdown from the most recent range, but it's also just right back into, you know, the larger range that we've been into, really all the way back into February. And if you really go back, you can see we went back to November. We had a range, we broke through that range, established a new range, broke through that range, established a new range, and that's where we are right now. So the most three recent breakouts have been through a range consolidation, a breakout, an establishment of a new consolidation area, a breakout, and an establishment of a further consolidation area. And that's where we are right now. On the Russell's been behaving quite differently. It also had weakness yesterday, but it's still certainly nowhere near the bottom of its most recent range. So very much something to keep in track of. When you start considering, if we want to have a bull market, we need to have the Russell lead. We need to have the transportations, and here's transportations, and this is certainly quite ugly. So I'm not going to say that I don't think that, you know, this one could not break through the bottom of this and lead to something bigger on both transportation as well as the broad market. It could happen this time for sure. At the same time, don't eliminate the possibility from your minds that this could just simply bounce, and then 2 days from now we could be right back to the top of the range. So don't take that possibility out of your head by being totally panic focused on the fact that, oh, we're coming down, we're going down, this is going to be the big one. Okay, so let's go ahead and take a look at our overnight action. As of the time of this cut, we were down, but just really only mildly. The S&P down about 0.19, the Russell and the NASDAQ down about 1/3%, the Dow down similar to the S&P. You had crude oil up big, up to over 2 points. 2 percentage points, I should say. You had the euro down mildly, about 1.4. Bonds are scratch, and then you also have gold up about 0.5%. And indeed, while we're mentioning bonds, take a quick look at the bond chart. You see this one also breaking down. If we're going to have a really significant move down in the broad markets, we're likely to see a move to the bond portfolio. And while obviously many people are unraveling their positions in light of increasing yields in bonds, and that backwind isn't going to change, you also have you know, if there's something serious going on, you'll still have a run to safety, and especially across the global perspective, U.S. bonds, long bonds, you know, this will be the run to safety area. And you know, if this is still coming down, it's hard to believe that we're going to have a significant down move in the broad market. But this has been uncorrelated of late. It hasn't meant as much as it used to. In the bigger picture, we usually think of bonds going in the opposite direction. It seemingly of late has been basically going the same direction as the broad market. but it's also something to watch if you're going to get the big one, that you're going to have a flight to safety in bonds, and that's certainly not being telegraphed as of yet. In terms of overseas action, general weakness all the way around. We have China down about 0.36%, Hong Kong 1.2%, Japan down 1.76%, Germany down 1.3%, and the United Kingdom down about 0.4%. In terms of macroeconomic reports for today, you have only this JOLTS job openings as an orange flag report, so not a lot of reports and certainly nothing much of serious hitting our day. In terms of tomorrow, we have crude oil inventories at its usual time and place, and there are some bond auctions and the like, but there's nothing else really of note in the U.S. market. In terms of volatility, obviously yesterday we put in a little bit more activity. The NASDAQ did peg a 1 standard deviation or greater move, though the other 3 indexes were less than a standard deviation. When you're seeing down weakness, we don't normally think of grinding down. We normally think of real energy in these down moves, and that really wasn't the case yesterday, with the exception of the NASDAQ. Short-term VIX 15.89, skew less than 125, so nothing really to get terribly excited about here. Implied IVs did push up a little bit, but they're still very low, and they're all below 35, and certainly not even at the middle point of what normal would be for the last 52 weeks. So very hard to get terribly excited about any of that. In terms of our regular daily report, we're still phase 3, higher highs, higher lows. IBD status remains a confirmed uptrend. GMI index has dropped. It's now 3 out of 6. And we still have these kind of mixed signals coming in. Our intermediate term market posture is very bearish, very bearish. Notice the word very in there. So something of a divergence from the IBD status. This, of course, is focused on a smaller time frame in general, but S&P has dropped below the 50 line. It's now in the very bearish territory. Dow is well below the 50 at a 30.5. NASDAQ also went bearish at 76.3. Only the Russell is in a bullish intermediate term market posture at 70.1 and bullish. You put this together with the other measures that we look at, we are at a hedge warning status of level 0 plus, normal with cautionary aspects, and we do have a number of cautionary aspects that are coming in addition to this market posture and the GMI at a 3 out of 6. You have these volatility warnings that have come in yesterday. Market in decline and sharp increase have both flashed again. We've had a rather repeated pattern recently of those flashing. We still have that fixed daily squeeze. Distribution count is not yet at warning status, but it is terribly close. We also had over 377 lows put in on the New York Stock Exchange yesterday, so that definitely hit warning status. And 2 of the 5 risk market aversion indicators have flagged as risk off. In terms of our special opinions, no changes there. Option income strategies, VIX is still inside the acceptable window. Just keep in mind the potential for increased volatility. Cover call still overall cautiously bullish with a 3-to-2 distribution between in the money and out of the money strikes. And put selling conditions are acceptable, but define that risk and consider scaling in. And certainly I've had a much smaller position in this strategy than is true in normal markets. In terms of sector specific, lots of red here. In fact, there is no sector in the short or intermediate term market posture that is considered healthy. And really, I wouldn't call any sector healthy at all. From a percent change yesterday, you see only one sector squeeze out a positive day. So this is certainly not the mark of a nice, healthy bull market, and you should treat it as such. So that should be enough for today. If you find this is helpful, greatly appreciate you liking us on YouTube, as well as be free to give us your comments and other support at the email address support@falconglobaltraders.com. More information available about what we do each day at this website. Performance matters, we get it, and we're very transparent with our journals and logs and our modeled position size. Disclaimers as always, hit the pause button if you need more time to review this. And we'll look forward to seeing you back here tomorrow morning before the market open with the market preview. Thank you.